We've all heard of MSTY by now, the YieldMax ETF tied to MicroStrategy, and its high monthly payouts. But this week, Roundhill is launching MSTW to offer weekly cash flow plus leveraged exposure to MSTR. Could this new sibling outshine its predecessor? Let's dig into the strategy, pros, and potential pitfalls. MSTW is part of Roundhill's weekly pay lineup. This ETF is designed to pay distributions every single week, and it's aiming for 120% of MSTR's weekly return before fees and expenses. That's leveraged exposure to one of the most volatile stocks in the market, reset every calendar week. MSTW uses a blend of total return swaps and even holds a piece of MSTR shares directly. It's a layered strategy, one that might offer more price stability compared to what we've seen from other funds. Meanwhile, MSTY is the YieldMax MicroStrategy Option Income Strategy ETF. It's designed to generate high monthly income by using a synthetic covered call strategy on MicroStrategy stock without actually owning the stock itself. It uses derivatives, mostly options and swaps, to replicate the performance of holding MSTR while simultaneously generating income. The fund sells call options on the synthetic MSTR exposure. These calls generate option premiums, which are then paid out as monthly distributions to investors. So what makes MSTW interesting? First off, weekly income. That alone might make some investors switch. Weekly payouts give you flexibility, reinvestment power, and for those who rely on ETF income, it's just a better alternative than monthly income, for various reasons. Second, the 1.2 times leverage. This could amplify gains in any strong week for MSTR, and with how volatile that stock is, we've seen weeks where it jumps 10, 15, even 20%. If you're holding MSTW, you're potentially capturing more of that action. And finally, let's not forget, this isn't Roundhill's first rodeo. Their other weekly pay ETFs have built a reputation for tight tracking and price stability. People in the high yield space are starting to notice how Roundhill's ETFs hold up compared to some of the other ones. But with the upside, you've got to acknowledge the downside. That 1.2 times leverage, it doesn't just boost gains, it also amplifies losses. If MSTR stumbles, MSTW doesn't just follow, it could drop even harder. This is a high-risk, high-reward strategy, and the risk is very real. And those weekly payouts? They're not guaranteed. They fluctuate with short-term market moves. If MSTR trades flat or quiet, your income that week could take a hit. MSTW is still tied directly to MSTR's price. If that stock drops more than 83% in a week, MSTW could theoretically go to zero. It's unlikely, but not impossible. And of course, it just launched, so there's no real-world track record yet. We'll need a few months, maybe quarters, to see how this thing really behaves. This is an excerpt from a letter written by Dave Mazza, CEO of Roundhill Investments, in response to questions from Adriano Staranieri of the Passive Income Investing YouTube channel. Adriano asks, is the 20% weekly leverage created using options? Dave replies, no. The 20% leverage is created using over-the-counter swaps. This allows us to construct a synthetic long position in a more tax-efficient manner than using listed options. What does this mean? Dave is saying that the 20% leverage used in Roundhill's weekly pay ETFs doesn't come from traditional options like many other ETFs use. Instead, they're using something called over-the-counter swaps. These are custom contracts made directly with financial institutions. By doing this, Roundhill creates what's called a synthetic long position, which means they're mimicking the effect of buying more shares, about 20% more, without actually owning them. Why does that matter? Because swaps can be more tax efficient than options. Options often trigger short-term capital gains, while swaps may offer a smoother, cleaner tax profile. So in plain English, they're adding a little extra firepower to boost returns when the stock goes up. And they're doing it in a way that could be gentler on your taxes compared to traditional methods like covered calls or leveraged options. Adriano asks, if you don't sell options, how are the weekly distributions generated? Dave replies, the weekly distributions are calculated based on the performance of the underlying stock. If the stock has a strong week, distributions will be higher. If the stock performs poorly, distributions will be lower. These ETFs are designed to be bullish instruments and use 1.2x leverage on the downside. While they may underperform covered call strategies during weak performance periods, they are built to outperform when the underlying asset performs well, as they do not cap upside returns through options. Dave is saying here that Roundhill's weekly pay ETFs pay weekly income based on how the stock performs, Bigger payouts when the stock goes up, smaller when it goes down. They use 1.2x leverage through swaps, not options, and don't cap your upside like covered call ETFs. What you get in return for holding these are full upside potential, weekly income, more tax efficient, and strong returns in bull markets. On the downside, you also get fluctuating income, amplified losses with leverage, no downside protection, and underperformance in flat or weak markets. Bottom line, the Roundhill weekly pay ETFs work best for bullish investors who want uncapped growth and don't mind fluctuating payouts. So, is MSTW better than MSTY? If you're bullish on MicroStrategy and want weekly payouts, MSTW is looking like a solid upgrade. But if you're someone who doesn't like leverage or can't stomach short-term volatility, this ETF might stress you out. To me, MSTW feels like Roundhill's way of saying, we see what the others are doing, now watch us do it better. And honestly, their approach is convincing. I'll be watching this one closely from day one, and based on the performance of their other weekly pay ETFs, I wouldn't be surprised if MSTW ends up outperforming MSTY. Just my personal opinion, not financial advice. So, what do you think? Is MSTW your new go-to for MSTR exposure? Are you planning to hold both MSTW and MSTY or make a switch? Let me know in the comments below. And if this breakdown helped you make sense of these high-yield monsters, go ahead and hit that like button and subscribe. Until next time.